Much of the thinking behind serious wealth happens away from the public eye. Advisors Angle aims to unlock that thinking. Together with wealth architect Neil Brink, we aim to explore how sophisticated investors build, protect, and steward long-term capital.
The concept of offshore has changed. Everything is global. I can access a conversation in Beijing. I can access a conversation in New York. I don't have to leave South Africa to have an offshore business agreement or an offshore investment structure. And that then means we now need to be looking at it differently.
You can, of course, access Beijing's stock exchange, the New York Stock Exchange, from your phone while sitting in traffic.
There we go. So how do you now look at offshore investing? Because surely that changes the fundamental architecture and foundation of how we should treat that. And we've spoken about how important it is to understand the foundations and understand the blueprints of what you're dealing with to best understand which one works for you.
Absolutely. So I think the very first important distinction for yourself to make: why are you reinvesting offshore, right? Because offshore investment works exactly the same as local investment. It should, for all practical reasons, be called investment, right? You should apply the exact same due diligence on an offshore investment than a local one. But it's technically a little bit more complicated. We take a look at a stock that's listed on the Chinese stock exchange. My Mandarin's not that good. So doing the due diligence on their financial statements is more complex. You've got currency movement between the yuan and the rand. That's a daily mover. So there's a couple of more things to consider. But the very first step is, why am I going offshore? Am I moving money away from South Africa? Is that my reasoning? Because I'm concerned about what's happening locally? Or am I moving money towards something, looking at an attractive asset on that side that I want to own?
That might not exist in South Africa
Exactly.
at all, or
Exactly.
that I might particularly like for other reasons.
Something very, very simple that all of us are quite comfortable with is electric vehicles, EV. I think that's the way of the future. I want to invest in EV. We can't do that in South Africa. We don't have an EV manufacturer. So you'll have to go and look elsewhere. So you'll either look towards China, BYD, or you look towards America and buy Tesla, because you want to move into a space that's not available locally. It's not for the sense of moving money away from South Africa.
It's to get returns that ultimately you want to be able to bring back into South Africa to live and use in South Africa.
Absolutely, because you're, as a tax-paying South African resident, your liabilities will forever be in rand local. So the money must ultimately come back to serve you. Right. So let's get into it.
Okay.
How do you know if your money is offshore or not?
Surely just by what you're invested in, right? Well, you'd think that
You'd think that.
that's how
One
simple
would
it is.
think. I mean, I've bought the Alan Gray offshore or the global fund. It must be offshore, surely.
Until it isn't.
Until it isn't. So the first thing we need to discuss is taking money offshore, because there's two very distinct, different ways in getting offshore exposure.
Not just sending the money offshore?
Not just sending the money offshore. And then, of course, we are also one of 17 countries, so not very common, that has exchange control legislation. So no, you are not allowed to take your own money after tax offshore as much as you like. We've got legislation against that. So two broad ways of taking money offshore. The first way is by taking it offshore directly.
Okay.
That means taking your money through a set of laws, through the South African Reserve Bank, and exchanging it for hard currency offshore. Then your money is truly offshore, right?
Okay.
The other way of doing it is by using what we call asset swap. Now, an asset swap, the money is not truly offshore. You make use of a corporate institution, such as a bank or a big financial manager, that has an offshore license, and they will sell you a product that tracks an offshore product.
Mm.
So the money is not truly offshore. It is still rand denominated.
Okay. We'll unpack that in a bit, Niels. I want to just get a sense of perhaps when we think about offshore investing. You touched on the reasons why people do it, and we kind of dipped into a bit around the benefits as to being able to realize returns and that. But in the offshore space, I find that a lot of conversations around that are in the dark. As an investor, as somebody looking for offshore exposure, there isn't enough that's being said around offshore investing. We're always told there's a New York listed company or there's a Chinese listed company, but in the offshoring of a portfolio, in moving money offshore, in investing offshore, let's talk structure. Do I just throw it offshore? Do I sit there and get a trust in Guernsey? Do I set up an asset manager in Mauritius? How do we, because you and I have spoken a lot around the importance of the right structure, right? And we'll come back to how to actually move the money offshore and
Sure.
the differences there. But when we build offshore, does that need to look different? Or, as you said, do we need to think about it as building the same way we'd build locally?
We absolutely have to think about it differently
Mm-hmm.
because remember, the minute we move outside of the borders of South Africa, we get introduced to international jurisdiction and legislation,
Okay.
something we need to be very careful about. In South Africa, it's very simple. You buy a security or you buy a unit trust, but all of them are taxed exactly the same under your South African Revenue Service Tax Act.
Mm-hmm.
The minute we move offshore, the IRS in the USA comes into play,
Mm-hmm.
the revenue bearer in the UK comes into play, Eurozone,
Wherever.
China's People Republic, that becomes interesting, right? So where you move, you've got currency fluctuation
Mhm.
and different tax legislation. So ownership and structure of utmost importance. I'd even want to venture to the point where I want to say it's more important than the end asset you buy.
And I like that you bring that point up, because what many people don't realize about going offshore is just because you've gone offshore doesn't mean you've left behind the tax obligations in South Africa. South Africa applies a double taxation treaty. So
Sometimes.
again, when you're not structured properly, you're opening yourself up to the existing South African taxes that you have, but also now the taxable obligations outside of South Africa.
Absolutely. Maybe we should head into a case study.
Let's do this. I am the client for this particular case study, and I want to be the client because more and more clients are finding themselves perhaps in similar situations where you're dabbling between different things. You might have different offshore interests. You might have different levels of income, different access. So say a client at 30 with 2 million rand to move offshore. And then I expect that by the time I reach 40, I will have 10 to 20 million rand to move offshore. Is that different in how we treat me as the client in any respect? Are there differences to what I can invest in, how I should be investing, how I should move the money? You touched on the fact that movement of funds happens very specifically, and then you need to know what you're invested in. Let's get into that from the perspective of the client.
The first thing I would ask you, if you framed it exactly like that, is why have you, before bringing us into consultation, already decided that you've got 2 million rand and you have to go offshore with it?
So,
Because your friend probably told you this is where you make money.
so I watched the budget speech, and I saw the minister announce the increase of the single discretionary allowance of sorts from $1 million to $2 million. And I thought, okay, that means I can move more money offshore for investment purposes. I've been getting a lot of emails from UK-based property developers and those based in Dubai saying, "Come and invest in our property market here. You can get a return and all of that." And I'm looking at the South African property market and thinking, Cape Town is ridiculously expensive. So how then do I get access to some of these returns? But I don't necessarily want to limit myself to property.
Of course. So essentially, the first way we'll take money offshore, we'll first have to look at your liquidity, right? So if you've got 2 million, you want to take it offshore and you are ready to forget about that money. Forget about it for, I want to call it 10 years, right? Then we'll go the direct route. So the direct route, you can take 2 million. That's the new lift now from 1 million to 2 million, single discretionary allowance. Or in layman's terms, we're allowed to move the money offshore without an application to SARB. So we'll take 2 million offshore, we'll exchange it for hard currency. To keep it simple, we'll exchange it for US dollar. So that's where the first hurdle comes into play. We have to look at the rand dollar exchange rate, and we need to pay someone, let's call it a bank,
To give us dollars.
to give us dollars. Of course. So there'll be a spread or a cost involved. You won't be paying the spot rate. You'll be paying spot rate plus. Okay. So if we look at the last couple of weeks, but forget the last couple of weeks, forever, the rand US dollar has been one of the most volatile currency pairs in the world. So that currency can move by as much as 50 to 80 cents in a couple of days. Something very careful to consider.
So that means we need to time when we move it?
Yes, sir.
Okay.
Then we'll take the money offshore. You'll typically, depends on who you work with, pay around about 10 cents extra on the rand dollar exchange rate. And we'll land up with US dollars in a offshore bank account.
So that's done.
It's done. You now own US cash.
Okay.
That will return essentially zero. To give you an idea, bank account return for US dollars is about 0.3% per annum. So it's nothing.
Whereas in South Africa, we can get, depending on how you have it in a fixed deposit and all of that, upwards of 5%, upwards of 10% in some cases.
Upwards of 10.
Yes.
The first simplest direction we can go is go to a fixed deposit or a money market account. And there it'll pick up slightly. You'll get up to 4-ish%, depending on where the rate cycle is at, right? But now you only own cash. The whole reason for taking your money offshore was to buy assets that is not available in South Africa. So to keep it in cash, you're only hedging the rand. The rand strengthens, you lose money. So now we need to move into an asset. And there we essentially have two different options of what we can buy with that money.
Okay.
The simpler, easier way of doing it is buying a unit trust or an ETF, an exchange traded fund. Why I like that is when we go the unit trust or ETF route, remember what I said about ownership and taxation in different jurisdictions.
Yes.
So we're going to be focused on America for this to make it as simple as possible. When you buy a unit trust, let's use a global equity fund as an example. You are not the owner of the equities. You are the owner of the unit trust, and the unit trust owns the equities. So there's an arm's length removal from ownership.
And that's not by you doing anything from a structuring and a legal perspective, but rather how that product itself is defined and structured.
Exactly. Why do we care about an arm's length removal? In American jurisdiction, where we are now operating in with our US dollars, if we were to own the securities directly,
So the Apple
Nvidia
shares.
shares, the Apple shares, the Tesla shares that you couldn't get hold of in South Africa.
Mm-hmm.
And you should pass away.
Oh, this is
Right.
now the estate conversation all
There
over
we
again.
go. You are now liable for situs taxes.
Mm-hmm.
That is similar to our estate duty. You mentioned a DTA or a double taxation agreement. I don't know why, but we currently do not have that with America. Maybe something we said. So that would mean you'll pay your taxes to the IRS in America
Mm-hmm.
up to 40%. Then the money will be repatriated, and then you'll pay estate duty in South Africa again on the same money.
Now, if we are to assume that I haven't passed away, that I don't have to pay estate duty, it doesn't absolve me from the situs tax. I'm still subject to the up to 40% offshore tax.
That's payable on death.
Mm-hmm.
If you don't pass away, then no.
Okay.
You'll only be liable for your South African taxes, capital gains on growth.
And when we repatriate those funds, so let's say perhaps we'll get into this as well. We've been outside for a certain number of years. We're now looking to bring those returns back.
So we'll sell the securities,
Mm-hmm.
trigger CGT locally,
Mm-hmm.
and then bring back the money. You'll pay spread again
Mm.
on the transfer of the currency,
Mm-hmm.
and we'll need to consider rand dollar.
Mm.
Because it's going to make no sense if you've made a 20% return offshore, you trigger your 18% capital gains taxes on that, and now the rand has strengthened like the end of last year.
Mm-hmm.
The money comes back and you suffer a 20% loss on the currency. Now we're back to square one with a lot of paperwork in between. So the simplest way for a 2 million client
Mm-hmm.
would be take it offshore through your SDA
Mm-hmm.
and invest in a unit trust.
Okay.
Just remember on that SDA, and there's been a little bit of movement on legislation in our F25 budget speech, or F26 budget speech. Your SDA is applied for all offshore expenditure.
Yes.
SDA runs on calendar year.
Mm-hmm.
So if we were to take your money offshore in the beginning of the year, let's say we do it in February, take the full 2 million offshore. March, you and the missus fly offshore and you want to swipe your card for a coffee.
Mm-hmm.
You're not allowed to do that.
Because you've moved your full
SDA,
allowance,
your SDA
the discretionary allowance. However,
Yes, sir.
in moving the discretionary allowance, I'm not limited, and this is now where we get into the application side of it. I'm not limited to only 2 million rand in a single year. And where it relates to the application, typically in the past, it was always a 1 million rand SDA plus 10 million rand via application. Is that, I get the sense that 10 million rand by application is not just 10 million rand.
It's not quite just 10 million rand. So the way that works, let's say SDA is spent, or from day one, you wanted to take offshore much more than 2.
Yes.
We wouldn't even have considered SDA at all. So let's say we want to take offshore 10 million or more. That would imply essentially 2 things. We'd apply through SARS
Mm-hmm.
to the SARB
Mm-hmm.
to take your money offshore. It's an application, and what it essentially boils down to is tax clearance
Mm-hmm.
and identification.
Okay.
We want to know exactly who you are,
Mm-hmm.
where did you get the money from, so
Mhm.
source of funds, and are you up to date with your taxes?
Mm.
If that is all clear and in the clear and up to date, they'll approve to take money offshore. Up to 10 million rand is fairly simple.
Mm-hmm.
If you were to apply for more than 10 million, you'll have to pay an additional application fee.
Mm-hmm.
And there's a couple of more points that they want to look at. They're just a little bit more arduous to get through.
But they're not saying no.
They're not saying no.
Okay.
They're
So
not saying no.
theoretically, I could move 20 million offshore
Yes, sir.
via application and
Yes.
still have my single discretionary allowance to use for that coffee.
For traveling.
Okay.
Absolutely.
So, Neelis, let's get into the nuanced side of it, because this is through SARS, direct applications, Jimmy as the individual, the client in their personal capacity. Now, I know some clients don't want that. What if I don't want the headache? What if I don't want to have to sit and deal with all of these things, but I still want the option to have access to that offshore market? How does that look?
So you want the diversification in your portfolio,
Mhm.
but you don't want to bother with this.
I don't need the red tape. It's too much work.
For two reasons. It's too much work. You don't want the red tape. And you may be not that comfortable with my 7 to 10 year time frame.
Yes.
You want to look at a couple of options for a year or 2, 3, simple as
Try it
possible.
out and see if it works.
Then there's another way to do it.
Okay.
Much simpler. We can either make use, and that would be under the asset swap legislation. Just practically how that works. You won't be taking money directly offshore.
Mm-hmm.
You'll be making use of a local rand-denominated asset that tracks an offshore asset. That's option A. That's a feeder fund.
Mm-hmm.
Or option B, what we call an institutional allowance.
When you say tracks an offshore asset, you mean the returns that this feeder fund has mimic directly the returns of the offshore product that I'm looking at. But that would then be subject to making sure that the feeder fund itself has the actual assets I want to be invested in offshore. So it wouldn't relate
And,
to properties,
course,
for example.
The feeder fund needs to exist.
Ah,
Because if we take the biggest asset managers in the world, typically situated in New York and in London,
mm-hmm.
when they plan a new fund or a new structure, the South African investor market is not really at the top of their list to cater for, right? So that needs to be created first. It needs to exist.
Mm-hmm.
So typically, if you want to buy a feeder, it's going to be from a South African asset management institution,
Yes.
such as PSG or Allan Gray or Sanlam. They will build an offshore fund, direct offshore, that you can buy with that.
Mm-hmm.
And then they'll build a feeder
Underneath that.
where you can invest to.
Mm.
So
But
much
your
more
funds
limited.
in the feeder, as you said, are not sitting in the offshore fund.
Rand denominated.
Yes. And they're not sitting in the offshore product. They are merely replicating the returns.
Much simpler to do. No application, no currency spread. 2 drawbacks.
Mm-hmm.
You're limited in what you can buy because
Mm-hmm.
it obviously needs to be available in South Africa.
Mm-hmm.
And then secondly, you constantly participate in currency movement.
How so?
If we've taken money offshore directly, sits there, bought a couple of assets, rand strengthens massively. There's technically, if you report it in rand, you'll see a loss. But it's only a reporting function. There's no loss of capital.
You're still
Right.
transacting in the US dollars that you bought.
And you don't have to bring it back.
Okay.
You can leave it there until the rand weakens again.
Okay.
In this case, it gets marked to market on a daily basis.
So every day we review where the rand dollar exchange rate is sitting, and that new rate gets applied to the rate at which we value the feeder fund on that day.
On that day, every day, regardless of your feelings.
Wow.
So in a rand weakening environment,
Mm-hmm.
lovely.
Fantastic.
In a rand strengthening environment, not so much, because you lose money daily.
Mm-hmm.
So something careful to consider when going this route.
Okay.
The second option, of course, institutional allowance.
Mm.
Typically only used when you want to get into an asset that's not available through feeder.
Mm-hmm.
You'll go to a firm like a bank. They typically have offshore institutional allowance.
As do asset managers like PSG.
Exactly.
Okay.
You will give them rands.
Mm-hmm.
They will take the money directly offshore through their allowance at a fee.
So the application now that we spoke about here is application done in the name of their entity,
Yes.
not in my individual name. However,
so no application for yourself.
however, you said the fee.
There's a fee that's annually charged for the usage of the license.
Okay.
Okay.
So now I'm paying more because somebody else is doing the headache that I don't
And
want
we haven't bought anything.
Yes. Yes. This is just
We're
for
still
the
in cash.
use. Yes.
This is just for the use of the allowance.
Oh, right.
Now we land offshore with USD,
Mm-hmm.
and now we can go and spend it typically by buying securities or UTs or whatever you'd like offshore.
Mm.
But you need to pay that license fee annually. And your money
Mm-hmm.
is not offshore,
PSG's money
is offshore.
is offshore. The institution
and
that
you've got a
moved
local
it.
agreement with them.
But then that also means I have to account for that fee in my returns. So if
Yes.
I'm expecting to make X amount of returns or whatever return I make, net return to me needs to start to look at these fees as well.
Absolutely. Absolutely. And now if we consider, let's make it very simple, cash local, cash offshore,
Mhm.
no end asset yet. We see a strengthening rand.
Mm.
Now you're essentially paying a fee to lose money.
Don't put it that way.
So very careful to consider, does that fee, that asset swap fee,
Mhm.
trump the trouble to go
The
through
trouble
that?
you go through there. Because here, I can also still, under the direct structure, I can also still speak to a wealth architect. I can still get that level of advice on how to fill out the application and
We
all
typically,
of that.
at PSG, we do the application for you.
Mhm.
It's essentially, you don't have to touch it.
Myth or truth, Neelis? Offshore investing is better than local investing.
This one's going to get me into trouble. Absolute myth.
Okay.
Absolute myth. It all boils down to what you are buying.
Why? Okay.
It is not better if the security or the end asset you are buying makes sense.
Mhm.
You can make money off of it. It doesn't need to be offshore. It doesn't need to be intricate. It doesn't need to be in another currency where you've got a second layer of risk introduced to it. The security makes sense. You'll make money. And most of the time, we can find something in South Africa, on the JSE or in our capital markets that can perform very similarly to any offshore stock. Perhaps just as a parting thought, it all boils down to the lovely book written in 1937 by Benjamin Graham, Security Analysis. If the end security doesn't make sense, whether it's offshore, local, or under your mattress, don't make the investment. Passive versus active investment. It's not simply the sense of the one's cheaper than the other. There's a lot of potholes in between.